Well, good afternoon, everybody. I'm Rick Edelman. Thanks so much for joining us on this program today. I'm very excited about it. We have a long-running series of webinars here at DAC-FP, as you know, and this one is going to be of, I think, particular interest because it eliminates a lot of the confusion that a lot of advisors have about whether or not they're allowed to engage in digital assets, and if so, how. We're going to be talking today about investing in crypto via picks and shovels. And to help us get into that, I'm very happy to welcome onto this program my friend Pedro Palandrani. He is the Vice President and Director of Research at GlobalX ETFs. Pedro, thanks for joining us on this webinar today.
Hey, Rick, thanks for having us.
Pedro's been with GlobalX for quite a number of years now, and he's got a long-standing career in this industry. And there is some content here that I want you to share right off the bat, Pedro, about GlobalX, because it's not a household name among advisors. So let's start there. Just tell us a little bit about GlobalX.
Absolutely, Rick. We're an ETF issuer based out of Manhattan, New York, but of course, we've been growing our presence, and now we have essentially a global presence, and we're managing over $40 billion in assets under management. And of course, we're known for our thematic suite of ETFs. You probably have heard about our LIT ETF, maybe the GlobalX Lithium and Battery Technology ETF, or maybe BOTS, or Robotics and Artificial Intelligence ETF. We're also known for our income suite of ETFs, for example, QYLD, our largest fund with about $6 billion in assets under management. That's the NASDAQ 100 covered call. And we have over 90 different ETFs. And as you can see on this slide, Rick, not only we focus on ETFs, but we also have an ETF model portfolio business led by our CIO team and John Mayer, our CIO. And also we're starting to offer institutional solutions, things like SMAs, for example. So we've been growing quite a bit. The company was founded back in 2008, but as I mentioned before, we now have over $40 billion in assets under management.
The thing that I find fascinating about GlobalX, and what I like the most, I own a lot of GlobalX ETFs personally, is the thematic approach that you take. When investors are looking for a specific theme within the broader global stock market of how to invest, GlobalX has dozens and dozens of funds that enable me, especially in the field of exponential technologies. I'm such a big fan of that space. My last book was The Truth About Your Future, all about exponential technologies. And GlobalX offers such a wide variety of funds that allows me to really target to specific areas, whether it's water or lithium power or robotics or artificial intelligence and so on. That it's just a really great set of offerings that you make available. And so I'm really glad to have you here talking about this. And as we get into this conversation about this one specific thematic ETF environment, crypto, Pedro is joined by two of his colleagues. First, Eric Anderson. Eric, good to have you with us on this webinar as well. Eric is a senior digital assets research analyst for GlobalX. And I'm really glad, Eric, that you're joining us for this conversation because you are specifically focusing on crypto for GlobalX.
I am, yes. Thank you. It's a pleasure to be here and excited to talk about picks and shovels with you today.
And finally, Christian Hazim, who is also a digital assets research analyst at GlobalX. I mean, my initial reaction is, wow, it's really rare for a mutual fund or ETF provider to have any attention at all about crypto. And yet at GlobalX, you've got two full-time analysts focusing exclusively on the digital asset space. So I find that really quite a testament to GlobalX's commitment and conviction of this asset class. Christian, welcome to the webinar as well.
Thank you for the invite, Rick. Happy to be here.
We've got a ton of questions, and I know everybody watching us has a ton of questions. In fact, many of the folks who are watching, more than a couple of hundred advisors from around the country, have already submitted a whole bunch of questions to us. And so I want to jump right into all of those. And Pedro, I want to begin with you. Talk about just fundamentally what GlobalX's view is of digital assets. Why does GlobalX go to the trouble of creating ETFs in the crypto space. We'll talk later on specifically about those and how they work and how easy they make it for advisors to engage. But what is the opportunity fundamentally that GlobalX sees, and how is GlobalX positioning itself to take advantage of all this?
Absolutely, Rick. And if we step back for a second, we've always trying to be ahead of the curve when it comes to bringing unique and intelligent solutions to our investors, right? So if you recall, back in 2010, we launched our lithium and battery technology ETF. That was well before electric vehicles were really a thing. In 2011, we launched our social media ETF, even before Facebook, now known as Meta Platform, IPO. So we've always tried to stay ahead of the curve, and that's something that we're definitely trying to do here on the crypto, on the digital asset, on the blockchain space. We really see a lot of potential. The reason why is that because if you think about the advent of the computing era, right? So every 10 to 15 years, you tend to have this new computing cycle, a major computing cycle that really changes many of our industry sectors in our economy. So, for example, back in the 1980s, you have computing, then a commercial internet came in the 90s, phones and smartphones came in the 2000s. So the natural question after that is what's next, right? If you're in technology or investing, that's the next question. What's next? And so we could argue it could be artificial intelligence, it could be gene sequencing and all of the applications of healthcare innovation that we're seeing, but also we could argue about blockchain, we could argue about digital assets, we could argue about cryptocurrencies, right? And I would say, like, for example, with blockchains, we're now going to be able to start doing things that were not even possible before because of that new computing power, right? So sort of the best analogy that I can come up with, Rick, is if you recall back in 2007, the first iPhone was launched, and it was very hard to predict back then what was going to be the killer app for the iPhone. It was really hard to predict that we were going to have the ability to jump in social networks like TikTok or Snapchat, for example, or maybe even having ride-hailing technology like Uber or Lyft. And I think that's what we're seeing today with blockchain technology. It's very hard to envision what's next, what are going to be those killer applications, even though cryptocurrencies are kind of that killer application today. But we know that blockchain technology has a lot more potential. So we're in the very early stages of adoption, of innovation in the space. And that's why we, as GlobalX, we're so interested in this space.
The fundamental concern that so many advisors have is that either they don't know how to invest in crypto, or their compliance department prohibits it, that doesn't allow them to engage. Or in many cases, the crypto companies don't really facilitate relationships with advisors. I mean, some of the biggest exchanges where you buy Bitcoin don't allow advisors to open accounts on behalf of clients, won't share the data. They won't provide statements to advisors. They won't allow clients or advisors to rebalance on behalf of all of their clients. They won't allow block trading. They won't allow you to rebalance. They won't allow you to debit your fee, which matters a lot to advisors. And so there's just been a lot of obstacles that advisors have faced in trying to add crypto to client portfolios. But GlobalX makes it really easy by doing something that's different. Instead of buying Bitcoin directly, you're engaging in what we call the picks and shovels route, which is what the title of this webinar is. But not everybody understands that picks and shovels story. So Pedro, explain to us what we mean when we are talking about investing in crypto via picks and shovels.
Absolutely, Rick. And first of all, you're 100% right. I come from the buy side before I joined GlobalX, and I totally get it. It's challenging, right? So at GlobalX, we invest essentially in the companies that are building the crypto, the digital asset, the blockchain ecosystem through, again, public equity. So that's a way that we're able to use the ETF wrapper and bring that solution to you. So instead of investing directly in the cryptocurrencies per se, it could be Bitcoin, it could be Ethereum, whatever, we're actually investing in the companies, many of which are public equities that allow us to capture the opportunities in the space. So at GlobalX, we have our blockchain ETF. The ticker is BKCH. BKCH, that's essentially trying to capture that picks and shovels approach. Rick, we also have our BITS ETF, BITS, which is essentially a Bitcoin futures plus blockchain exposure within that ETF. Is essentially a 50-50 type of exposure. And in Europe, we've brought to market ETP products on Bitcoin and Ethereum. And again, we're just getting started. Like I mentioned before, you recognize that we have here a couple of dedicated crypto analysts, but we also have dedicated product development people at the company. We have dedicated institutional sales or distribution efforts as well, only on the digital asset space. So clearly, as a company, we believe in this space and we're fully committed to it.
So the way I like to phrase it is that, there are a couple of different basic ways you can invest in crypto. You can buy Bitcoin directly, which has all the challenges I just mentioned for advisors trying to integrate that in your practice, compliance officers, putting on the brakes saying, wait a minute, we don't know about this. On the other hand, you can invest in an ETF. It's an ordinary ETF in the sense that it's like every other ETF. And you're familiar with ETFs. Advisors use them all the time. Clients are familiar. They like them. They're the most popular investment vehicle in the country for all the reasons we know. They're very inexpensive, fully transparent, highly liquid, that allow you to invest in companies, in this case, specifically engaging in the infrastructure of crypto. In other words, I might love the auto industry, but that doesn't mean I got to buy Ford or GM. I can invest in concrete manufacturers because cars have to have roads to drive on. I can invest in companies that are making toll booths and white paint for those roads. I can invest in the picks and shovels route. That phrase comes from Levi Strauss, who went to the California gold rush, and he never mined for gold. He sold blue jeans to the gold miners. So he became wealthier than any of them. And that was the attitude. Don't mine for gold, sell picks and shovels to the gold miners. And that's what you're doing with your ETF, investing in companies that are engaged in the blockchain crypto development space. And it's a way you can invest that is directionally in sync. It's not a direct exposure to Bitcoin, but it is essentially following the same path. So I think this makes it incredibly easy. There isn't a compliance officer on the planet who would object to this because it's just an ETF from their perspective, like any other, coming from one of the largest ETF providers in the country, Global X. This is a no-brainer in that regard, and it allows you to check the box for your client of providing them a crypto exposure. But I need to go backwards a little bit. And Christian, I want to turn to you for this. It makes sense from everything that Pedro has described that Global X offers a crypto ETF. Actually, you've got two of them, as you've mentioned, one that invests exclusively in stocks, another one that adds a futures component. But explain for us, Christian, the fundamental argument for including crypto in a client portfolio in the first place. Why should we do that?
Yeah, so in our view, blockchain technology is disruptive force, right? But the space is very nascent, and we're seeing a lot of growth in users, the amount of developers that are building in the space, the amount of institutional participation and partnerships. We've seen an expansion in the products that are being built through blockchain technology. And why have we seen this growth? Because the efficiencies of blockchain technology allows us to build a better infrastructure, because we can create a permissionless and decentralized framework by which we can validate data. And that data is secured via public consensus. So we remove the need for having a top-down authority that we need to trust on, right? It allows us to verify data because the data is distributed across all of these participants that participate in the security of this decentralized database. And then through blockchain technology as an infrastructure, we can start to create applications on top of it because it is a very effective way to manage data. So we've seen better financial instruments being built through smart contracts. And we can start to think about things, bringing your digital identity on chain, bringing your data on chain through the values of cryptography. So in our view, advancements in blockchain technology are perhaps one of the greatest innovations in recent years. And through digital assets and the companies that are benefiting from this technology, investors can participate in the growth of the space.
So you mentioned several examples of how this improves business. Basically,
Yeah.
this new tech lets businesses operate faster and cheaper and safer than they can with alternative traditional business methodologies. But how far along are we in the adoption curve? Is this something that most businesses are in fact using today, or is that yet to come?
Yeah. So if we think about the adoption curve, it's this, this S curve from left to right. And the first bucket that we see is innovators. We then see the early adopters. Then we see an early majority into the space. Then we see a late majority, and then we see the laggards, right? We like to think that digital assets and the technology that is blockchain is really in that innovator stage. And the reason why is the amount of users that are participating in blockchain technology is quite low compared to the total addressable market. But the users are increasing over time. The hardware and the software required to access this space is not user friendly yet. So as you may know, it's not like you can pull up an email and access these things. The infrastructure is fundamentally different. You have, public keys, private keys. You have to access dApps. So really the infrastructure to access the technology is not there from a UI perspective. We also have, the lack of regulation. Where is this space where is the space heading? How is the government going to regulate this? How can we safely participate in this space, knowing that we're not doing anything wrong? And then lastly, we need greater institutional participation to move along that adoption curve. But what's great to see is that regardless of where we are now in such an early stage of the adoption curve, we've seen the number of venture capital and crypto deals going through the roof. I think in 2021, KPMG reported that there was over $3 billion invested in the space. We've seen a shift in talent from traditional companies into what we call Web3, the companies that are building based out of blockchain infrastructure. Like I said, the number of users, while low, is increasing. The amount of transactions is increasing, and regulators are starting to pay more attention to the space, right? So all these factors can propel us to the next stages of the adoption curve, but we are very early, Rick. We're super early.
So what do you think it's going to take, or how long do you think it's going to take for us to go from the early adopter phase to more of a mainstreaming? What's your expectation?
That's a great question. It is really unclear to me because regulators haven't gotten a hold of this technology. So first, we need to identify how we regulate this. Who is going to regulate it? What are the rules and best practices that are going to be implemented that allow investors to feel safe in this space? But we are seeing partnerships with companies. We just saw that Google is starting to offer Ethereum node services. So we're starting to see these partnerships come into play. As more partnerships come with traditional companies, we expect that access to blockchain technology will become more mainstream. So to answer your question, a clear image, a clear view on regulation, and then the further enhancements of partnerships will help us onboard more users, and then it will help us, build the technology in such a way that allows for easier access and for better implementation of this technology.
So you mentioned that it's the regulators or the lack of regulation that are an impediment right now to a broader adoption. Are you optimistic or pessimistic that we're going to get that regulatory clarity?
I'm optimistic. I think that the regulators will find that there is value behind the efficiencies of this technology, and the United States really can't afford to fall behind in participating in the innovation of technology. So I'm optimistic. I can't really give you a time frame, but I do hope and I do expect that we're going to get more clarity and a positive path forwards in the months and years to come.
Which would argue that, or would you argue, rather than my saying it, let me ask you this. Do you think that the current low price of digital assets and the stocks that are of companies that are engaging in this space will be improved when there's regulatory clarity? In other words, if you're optimistic, we're going to get the clarity at some point. Does that make today's pricing a buying opportunity?
Perhaps, I do think that with regulation, that will help onboard the users that are sitting on the sidelines. It would help onboard the institutions that are sitting on the sideline, and naturally that creates a volume and interest in the space, which reflects in price. I can't really comment on whether or not this is a good moment to buy, but what I will say is, the technology, the space is early, and I think there's a lot of room for potential to grow.
And that really leads to the question of what specifically. So, Eric, let me turn this over to you and drill down into, out of this concept, which Pedro and Christian have laid out really nicely for us. Let's get down into the trenches of the companies we're actually talking about here. I mentioned the picks and shovels approach and the analogy to the California gold rush. Who are these picks and shovels? What are those companies that are engaging in blockchain and digital assets?
Yeah, great question. We like to think about picks and shovels in buckets. So BKCH, for example, is segmented into a number of subcategories. I can go over those quickly right now.
Yeah, please do.
The first of these is likely the one that people are most familiar with in reading the news. That is digital asset mining. So mining companies, maybe you've heard of Riot Blockchain, Marathon Digital, other companies like that. And these companies are mostly in the news because of topics talking about their pollution and their large carbon footprint. These companies are particularly important to the maintenance and security of the Bitcoin blockchain. So digital asset mining really only applies to crypto assets that function on what we refer to as a proof of work consensus mechanism. I don't know if I need to go into the details of how that works here, but what is needed to be known is that proof of work is able to generate consensus on the state of a network or a data set by engaging in cryptographic proofs that require massive amounts of energy. So you'll hear, X company or their Bitcoin industry uses more energy than Norway or Costa Rica, or headlines like that. What's important here is that these companies can be kind of thought of as fulfilling a similar role to that of banks. So if I want to send a transaction, a wire to you, Rick, I'd go to my bank, submit a wire letter. The bank would look at my ledger, my account, verify that I have the assets, verify my identity, and then actually transfer the assets to you, and then ensure that every bank around the world knows that you have the money and I don't. That's the same function that a Bitcoin miner generally fulfills. Transactions are packaged in this thing called the mempool, which is just like a pool of unconfirmed transactions, and they engage in proof of work mining to cryptographically prove the veracity and legitimacy of the transactions. They then propagate those throughout the network and actually transfer assets from one account to another. So Bitcoin doesn't really exist without digital asset mining. Digital asset mining doesn't exist without Bitcoin. They're intrinsically tied to one another. So that's the first main bucket that I would talk to. The second one is the hardware providers for these digital asset miners. So in the early days of, once again, we'll talk about Bitcoin, the main proof of work crypto asset. In the early days, you could mine Bitcoin profitably using your home computer, using a CPU or a GPU. However, the Bitcoin network is designed to adjust the difficulty of mining Bitcoin by the amount of computing power that's on the network. More computing power on the network means that it's more difficult to mine Bitcoin. So what's that meant as enterprise scale Bitcoin mining operations have come online is that you've needed to build out a whole new industry of hardware specifically designed to mine Bitcoin. So a term that many listeners may have heard is the term ASIC, ASIC, which stands for Application Specific Integrated Circuit. And what this is really just a computer chip that is really bad at doing everything except for mining Bitcoin. That's the only thing it does, and it's incredibly efficient at doing so. So you have a host of companies that that exist simply to design increasingly advanced ASICs, and these are highly in demand, especially as the price of Bitcoin has appreciated. In BKCH, the main ASIC provider that we have is a company called Canaan. Following that subsegment, I would move on to blockchain and digital asset transactions. Once again, this is an area that many people are likely familiar with, and broadly, these companies provide on-ramps and off-ramps to crypto from the real world. So providing the piping that allows you to transfer cash from your Bank of America account to trade that for Ethereum, Bitcoin, whatever, and eventually even be able to transfer that directly onto a self-custodial wallet and be able to use these assets productively. So think companies like Coinbase, PayPal, Square, or Block is now what it's referred as. And then the final main category is broadly just blockchain digital asset integration and application companies. So these are companies providing engineering and consulting services and the tools to enable the integration of blockchain technology into the business models of companies, or to provide tools to institutional investors seeking to integrate blockchain into their investment strategy. So I can stop there. It's kind of a bit of information, but that's how we generally think of picks and shovels.
So you've cited 4 major categories, and really eloquently, thank you for that clear explanation on those 4. How many different companies are there in each of these categories that are publicly traded and available for you to add to the ETF?
Quite a few. I think at last count, the total amount of crypto companies that were publicly traded was north of 50. I think the last number I saw was 56, though I could be wrong on that. It really depends based on the sub-segment that we're talking about. There's quite a few Bitcoin mining companies. ASIC producers, there tend to be less of those. Many are domiciled in China and you can't access them via traditional means. So Canaan, like I mentioned, is the main ASIC provider that we have there. And then when we go into talking about blockchain and digital asset transactions, I mean, that's a space that's growing all the time, especially as you see blockchain and digital assets be further integrated into fintech companies. I mean, we saw an explosion of fintechs over the past 5 years, and the momentum is only going in one direction in terms of the integration of those of that technology and those assets onto those platforms. Now you see, PayPal, you can buy and trade Bitcoin and other crypto assets. Same with Square. They literally renamed the company to Block. So the ecosystem is growing very rapidly, but it really depends on the subsegment that you're looking at.
Pedro, let me go to you on this. Does it surprise you that all of this development, I think most people will be surprised to hear that there are 57 companies publicly traded. There are thousands more that are not public, but 57 companies publicly traded here in the US that are emphasizing digital assets. Does that surprise you that there are so many?
It doesn't really surprise me. I think generally we tend to see innovation being reflected in the public markets at some point, and that's something that we really just saw over the last 2 years or so. Rick, here at Global X, we've followed blockchain technology and digital assets for more than that, way more than that, I have to say. But it's only been until recent years that the public markets have grown sufficiently to actually provide access to these companies. Eric mentioned 50, 56. Within our BKCH ETF, we actually only have 24 because at the same time, we try to protect investors by looking at minimum market cap requirements, minimum average daily trading volume requirements, right? So we don't want to invest in very small companies that would then cause some sort of liquidity issues, for example, by looking at the ETF structure. So within our BKCH ETF, we have about 24 companies. And like Eric mentioned, a lot of the companies that we know of today are really in the transaction space, like Coinbase, in the hardware space, like Canaan, in the other segments that he mentioned, but not really in the implementation or integration, Rick. And this is important because we believe that in the future, in the next 2-3 years, we're going to start seeing companies going public that are coming out with application of blockchain technology in areas like healthcare, for example, or logistics, or you name it, so many different areas that could apply blockchain technology. And these are the companies that are probably not going to be even linked to digital assets specifically, but would also provide interesting investment opportunities.
So I think it just reflects the fact that this category is really no different than any other sector of the S&P 500 or the broader markets, that most financial advisors are not really expert at security selection. We don't spend our time delving into the S&P to figure out which stocks ought to be in our client portfolio. That's why most of us prefer to use ETFs. We delegate that chore, frankly, to folks like you, so that you can say, oh, there's 57 of them, but we're only going to pick less than half for the fund itself to make sure that we're providing the biggest and best and brightest candidates for our client investors. So I think that makes a lot of sense. And I think that would give investment advisors a lot of confidence knowing that they don't have to become experts in security selection in the world of crypto, that they just treat this like they do any other ETF, decide thematically you want to have an exposure to crypto, and then leave the dirty work to you guys. So I think that makes an awful lot of sense. What else? You mentioned, the 4 categories that exist and how you select them based on liquidity and size and volume, et cetera. What other considerations are there, Pedro, for investors when they're considering a crypto-related ETF?
Absolutely. I mean, when considering any ETF, to be honest with you, I think what's important to see is kind of what's under the hood, right? What's the exposure that you're actually getting? Are you actually getting exposure to the companies that are leading in the space and that most of their business is associated with that thematic opportunity? I think that's the right approach, right? I think if you want to invest in blockchain technology, for example, you want to invest in companies that are at least generating 50% of more of their revenue from blockchain activities. And Eric just described those different verticals. And I think that's what we do at Global X within our BKCH ETF. We're really trying to identify what are those companies that are generating at least 50% of the revenue from the different verticals that we have identified within blockchain technology. And I think that's the right approach, right? Instead of investing in companies like ABM or large consulting companies that might have just a small verticals within blockchain technology, we're actually investing in the companies that are fully associated with blockchain verticals. And I think, again, as an advisor, as an investor, I think that's really what we're trying to provide exposure to.
Yeah, I think that matters a lot because, IBM is pretty well known for having a heavy engagement in blockchain. People are sometimes surprised to hear that. But when you think about it, of course, IBM is one of the biggest tech companies on the planet. Of course, they're going to be engaged in blockchain, and they are in a very heavy way. The problem, of course, is that it's such a massive company that its blockchain activities are so trivial relative to its total revenues. You're not moving the needle. That if you're investing in IBM in this fund, you're kidding yourself. It's blockchain's activities is not moving IBM share price. So I think that makes a lot of sense as to why you would exclude it from a fund of this type. That certainly makes sense. And it's further illustration that we need as advisors to stay out of the kitchen. We don't need to be engaged in figuring out which stocks specifically ought to be included in the crypto sleeve of the portfolio. Buy an ETF such as BKCH and it'll be taken care of for you. You don't have to worry about it. Are there any other particular aspects of the fund's construction or operations that are worth noting?
Absolutely, Rick. And something that is really important as well is the weighting scheme, right? Christian talked before about the fact that we believe that this theme is in the very early stages of adoption, right? In that innovators phase. What tends to happen in this phase is that you're going to have a lot of winners and losers. We're cognizant of that. we understand that it's going to be very hard to actively select who's going to win and who's going to lose. So what we do is we implement a market cap weighting scheme that essentially allows market dynamics to dictate which companies should have a higher weight in the fund and which companies should have a lower weight in the fund. So by doing that, as the companies are recognized as winners and their market cap grows, we're going to own more of those companies. And this is a much better approach than something like an equal weight approach, Rick, right? Because ultimately an equal weight approach is going to sell winners and buy losers at each rebalance and reconstitution frequency. So again, that market cap weighting scheme is critical. It's something that at Global X we've implemented within our thematic suite of ETFs, because in many cases, a lot of these themes are in those early stages of adoption.
So I think that is a really important point to recognize that it's the construction of the portfolio that matters as much as the components of the portfolio. So I think that's a really strong point in Global X's favor. Eric, I want to ask you a question about something Christian said a moment ago. Christian talked about the mining activities, and you provided some pretty good explanation of proof of work and the fundamental mechanics of how this operates. But talk about the use of a Bitcoin miner as a proxy for buying Bitcoin itself. I mean, we all are familiar with gold miners, because they've been around so much longer, and gold ETFs, they've been around for, a couple of decades now. And so we kind of get the fact that a gold mining ETF is going to pretty much track the price of gold, that the profits of mining go up and down with the price of gold because the costs of mining are relatively fixed. Talk about that relative to Bitcoin. Is it kind of the same thing, that a Bitcoin miner's stock price is going to move up and down with the price of Bitcoin?
Yeah, it's a great question. And I think the use of the term mining is particularly helpful in drawing that correlation. So I can just speak to kind of how they parallel. So a gold miner, not my area of expertise, but from everything that I can glean, gold miners invest money in hardware that allows them to go dig up a bunch of gold, prospect for it, dig it up, do geological surveys, and then extract it from the ground, extract the ore from the ground, and then ship it off to be processed and smelted and what have you. Bitcoin mining is very similar in this regard, except for it's just done digitally. So these companies invest heavily in hardware, the ASIC hardware. And what they do is they take this hardware, they utilize massive amounts of electricity to engage in this hashing, which is the proving of the veracity of transactions on the blockchain and securing of the blockchain, and propagating this to the network. Now, they don't do this for altruistic reasons, much like gold miners don't do it for altruistic reasons, that you can have a nice necklace or nice jewelry, or we can have iPhones. Bitcoin miners are rewarded for their efforts. So they burn massive amounts of electricity, which costs money, and they spend quite a bit of money on ASICs and other hardware. They're rewarded for doing so in Bitcoin. There's a Bitcoin block that's propagated every 10 minutes on average. The miner, the individual ASIC that determines the correct hashing algorithm to prove the veracity of a block and propagate that to the network, they are rewarded in Bitcoin. Currently, the reward stands at 6.25 Bitcoin per block. So every 10 minutes, 6.25 Bitcoin are mined, or basically created out of thin air. There's a cap on the total amount of Bitcoin that will ever be created. That cap is 21 million. But currently, Bitcoin miners get this Bitcoin, and generally what's standard practice is, for the most part, they will sell it immediately on the market, get cash, and use that cash to pay off their real world expenses like electricity and pay off the loans that they have to have purchased ASICs. So with this parallel, generally you expect Bitcoin miners to follow the same price trends as Bitcoin because their revenues are denominated in it. Now, it's certainly not a one-to-one correlation, and that's for a whole slew of reasons, namely taking on debt to be able to buy these miners. So you have idiosyncratic factors that come into play here. And also recently, what's been a big talking point is just the surging cost of electricity. We've seen the cost of profitably mining Bitcoin rise significantly over the past year on the heels of energy insecurity in Europe and just like the rising cost of energy in general. So as such, it's definitely not a correlation of 1 to the price of Bitcoin, but certainly it's quite high. It's usually somewhere in the 0.8 to 0.9 correlation area. And over the long term, Bitcoin miners, those that are successful and are able to generate enough scale, will certainly follow very closely the price of Bitcoin.
Are they profitable these days, given the relatively low price of Bitcoin compared to a year ago?
Yeah, it's a great question, and you catch us at a time where these mining companies are not profitable at the moment. What's unique about the digital asset space is that it is, as we've discussed, it's so nascent and so young. It's such a high growth industry. I mean, when you think about it in context, Bitcoin was invented in 2009, and Ethereum and all of these smart contract platforms, the concept of Web3, DeFi, all of these different sectors, they've only been around for 4 or 5 years. So, you know, most industries that have been around for, call it 10 years, are not generally profitable. They're investing lots of capital into their businesses and trying to accelerate growth as quickly as possible. That's no different with crypto, but what is different with these picks and shovels is that we've seen flashes of significant profitability in the past. In 2021, many miners were profitable despite plowing much of their profits back into mining assets, or developing, or building out completely new mining warehouses. The same thing, I know you didn't ask about like Coinbase, but for example, Coinbase saw significant profitability throughout 2021. Now, as we moved into 2022, a more challenging macro environment, higher energy costs, these companies are, at the end of the day, very nascent. We are all the way out on the risk spectrum here. So as macro kind of gets out of hand a little bit, these are the first companies to pull back, and the cost of electricity hasn't helped that. But we have seen those flashes of profitability. Long term, as we get into a more normalized macro environment, and we see adoption of digital assets continue, I would expect to see these companies return to profitability over the long term.
So, Christian, you've heard Eric several times talk about the incredibly high energy costs that miners incur. Is that the full story about Bitcoin mining? Is it really as bad for the planet as many people argue, or is there more to the story? And you're muted at the moment, Christian.
Yeah, so if you think about the business model for mining, right? You compete to mine these blocks, right? And your revenue comes in the form of Bitcoin, right? What are your costs, right? Your costs are the cost for hardware, the cost to host that hardware, and the cost to power that hardware, the hardware, which is electricity, right? And then your profitability is determined by, can you mine this asset? Are you successful in mining this without having too many costs that can offset the revenue of the values of the Bitcoin that you get back? So because miners are incentivized to reduce costs, naturally they will shift towards green sources of energy, to utilize excess or wasted sources of energy to mine for Bitcoin. So yes, they are energy intensive, but we also think that miners help us transition into a green environment because they are naturally incentivized to seek alternative and cheap sources of energy.
And what do you mean by wasted energy that they try to capture? What energy might be wasted if not used for crypto mining?
Yeah, so if you think about like the Texas grid, you have to produce excess energy to meet the demand, and sometimes that excess energy is not used. So Bitcoin miners can grab that energy efficiently instead of wasting it and use it to mine Bitcoin. So that is one of the examples of this usage of waste and excess energy.
Similarly, if they're using water power coming off of a waterfall, that water is going over the cliff, whether you're harvesting it for energy or not. So you're
Correct.
either using it or you're just letting it waste, running to the ocean. So
Yeah.
there are a lot of examples of this. I guess the bottom line is it's not so much the energy you're using as the CO2 you're tossing into the atmosphere.
Exactly.
And the more we go green, the less CO2, and that's really the issue. Cambridge does an annual report on crypto energy consumption, and they say that about half of crypto mining is green energy, which would put it at the highest of any industrial sector.
Yeah.
The transportation industry is at the exact opposite. Virtually none of the transportation industry is green. We count in the hundreds of thousands the number of electric vehicles sold out of the tens of millions of gasoline powered cars and trucks. I find the argument about the energy usage of crypto to be a little bit of a canard. I don't think yes, it's a big deal, but it's a big deal in every industry. It's not a particular issue in crypto. It's just people like to use it as an argument for reasons they don't like crypto. But I'm not sure how much I buy that. Pedro, do you share the view that I'm describing here?
100%, Rick. And the reality is that you mentioned 50%, 5-10 years down the road, that number is likely going to be much greater because solar, wind, and all of these renewable energy sources continue to become cheaper. And like Christian explained, miners are incentivized to invest in these cheap sources of energy. So that's where they're investing most of their money today. That's where most of the energy will come in the next few years. And therefore, like Christian said, the path towards clean energy is really going to be within what we're seeing in the crypto mining ecosystem.
So when it comes down to allocating in crypto, what are you, and I'm not sure which of you wants to answer this. What are you seeing among advisors when they are allocating to crypto? What percentage of the portfolio are they generally allocating? Is it 1%, 50%? What are you seeing?
I guess I'll take the first stab at that. And again, I come from the buy side, so totally understand that a lot of what the buy side tends to do is that capital preservation. That's really key, right? However, at the same time, we're always trying to capture alpha opportunities or excess returns and generate some significant returns for our clients. So generally speaking, allocation within a portfolio tends to be less than 2 or 3%, to be honest with you, Rick, right? Usually we tend to see 1%, 2% within some of these digital assets. And that's really for advisors that are implementing this type of asset allocation within their portfolio. Generally speaking, when we look at a holistic thematic bucket within that equity allocation within the portfolio, we tend to see 10 to 15% allocation towards that thematic bucket. However, again, digital assets, blockchain tends to be that 1 to 2% weight within that allocation. However, the opportunities for return are quite significant, right? We've seen that over the past years, and we really believe that there is a unique opportunity here. A small percentage of allocation within some of these digital assets can really pay off over the long term if we see an appreciation like we saw in the past.
Which is, I guess, why you're only seeing a low single-digit allocation. If it performs as many hope, including me, you don't need to have a large allocation. It'll have an outsized impact on the portfolio, even if it's a low single-digit allocation. And at the same time, if it goes the wrong way, because as you've all said, I think, Eric, you said this is the riskiest of assets. If it does go the wrong way, a low single-digit allocation, that might be annoying, but it won't be devastating. It won't interfere with your ability to retire in financial comfort. So do you share that view, Eric, that low single-digit allocation, does that surprise you that that's what advisors are doing? Do you concur that that's for a lot of advisors, the correct allocation?
Yes, I do. As we've mentioned a number of times here, this industry is new. We're still open to quite a few risks here, both on the regulatory front and just on the adoption front. I see the value in this space. I think it has incredible disruptive potential. But we have to also acknowledge that we are very early here, and picking winners and losers is a much more difficult task than I would like it to be. As a result, I think, as you mentioned eloquently, allocating 1 to 2% of a portfolio, you benefit from the upside if your conviction is proven correct, and you do see long-term adoption of this technology, and you see price appreciation as a result. On the downside, this space is volatile, and crypto equities, while they are not correlated one-to-one with crypto, they are highly correlated, and a lot of people, advisors, are not going to want to go to their clients and say, "Hey, you just had a 70% drawdown on your portfolio over a month." So I think a 2-3% allocation makes a lot of sense. This is disruptive technology that is going to revolutionize the way that we interact with data going forward. It's going to disrupt many industries, in my view. It would be, to me, the risk of not investing is greater than of investing, but it's a matter of managing that risk appropriately within the context of a portfolio. And the last thing I'd say is just the importance of being able to, I think we'll see allocations start to get a little bit larger as education in the space improves. Advisors, once again, are going to want to go to their clients and be able to explain what it is that they're investing in. And as that education improves, I think many of us will feel more comfortable putting some chips onto the table and saying, "Hey, this is why I have conviction in this. This is why it's going to change X, Y, and Z industry." So,
yeah, I think you're right about that. The way I phrase it is that if you do 1% in crypto and you're wrong, you lose 1%. If you do none, you could be 100% wrong. Because the opportunity for upside, I think, so dwarfs the downside risk. But that's something we're all going to have to wait and see how it truly plays out. One of the curiosities is that both of you, Christian and Eric, are research analysts focusing on digital assets as a career. So I'd like each of you to spend a moment as we wind down here, talk about your day. Where is it you're getting the content that you're getting? How do you pay attention to this? Because it isn't mainstream. You can't go to Bloomberg. You can't turn on CNBC the way we can for the financial markets. So, Christian, how did you learn what you've come to discover?
Yeah, it's a lot of self-interest. So the way I got into this space is I started reading white papers and understanding the value of this technology and what does Bitcoin do and what is the difference between Bitcoin and Ethereum and what are smart contracts. And that just takes you down this rabbit hole for you to understand the things that can be built based on this technology. So my day-to-day is, reading white papers, researching, projects, understanding the value proposition and trying to convey a simpler message to investors and advisors as to, what are the value propositions? Why should you participate in this space and why this space has the value that we think it has? Valuating this space is completely different than the way you evaluate traditional assets. So coming up with that framework, and it's a space where technological developments and things happen at a really, really fast pace. So keeping track of the developments, keeping track of the things that are, worth keeping track of, and seeing just the overall space grow.
And Eric, about you?
Yeah, the day-to-day, I come from a very traditional financial background. I worked in private wealth management before this as a portfolio analyst. So my interest in crypto really started 5-ish years ago. Similar path to Christian, just hearing about this stuff in the news and then just taking it upon myself to read white papers to just try to understand what all of this stuff even is. I mean, I live in San Francisco, so it was all the buzz out here for so long. And then the day-to-day now, I mean, God, talk about a space that moves quickly. It is breakneck speed in crypto all the time. And the news sources are certainly not what you'd expect from the traditional financial services world. Like you said, you're not on Bloomberg, you're not on Morningstar. But what I will say is, as this space has developed over the past 5 years that I've been interested in it, the amount of institutional interest in the space, the amount of money, effort, human capital going into putting out very in-depth, comprehensive education and research in the space is incredible. It is just completely exploded. So, I mean, we use a number of incredibly high quality sources to do research, to keep up to date on what's going on in the space. And then really it's just, it's just a matter of kind of like holding on for dear life as you go through the space, because it just moves so fast. And I think that's really just a testament to the amount of money that's coming into the space, the amount of developers that have migrated to the space, thousands of new jobs being created in this sector. And I think it just stems from the realization that, the stuff isn't going away. We've seen down cycles 4 different times now of large drawdowns and people proclaiming that crypto is dead, it's never coming back, and it always comes back with a vengeance. And the use cases now are being proven out. And so that's just, it's instilled the need in people to have these credible sources of information that ultimately Christian and I benefit from through our day-to-day.
Yeah. Yeah.
And this is why I think it's so important for us to remember our roles. As advisors, we should be focusing on the client relationship as opposed to the portfolio management. And that's why the use of ETFs has always been my favorite. With the REA I created was the biggest user of ETFs in the country. Why I'm personally such a big fan of Global X ETFs and the unique positions and offerings that it provides to advisors to solve unique portfolio management problems and to delegate the chore, which I'll call it. I mean, it's your bread and butter, but to me, it's the chore of managing the money on a daily basis. I'd rather spend my time managing the client rather than managing the money. So it's why it's a great partnership. And I'm really glad that we were able to spend this time here today talking about the new innovative ETFs that Global X offers in the area of crypto, BKCH and BITS. So I just want to say thank you so much to Pedro Palandrani, the Director of Research at Global X ETFs, and to research analysts Eric Anderson and Christian Hazim. Thank you, gentlemen, for joining us on this program today. If you would like to learn more about Global X ETFs, that's exactly where you go, globalxetfs.com. And you will find all of the funds available, the research materials that Global X makes available, direct access to the team at Global X, so that you can get their benefit in helping you manage your clients' assets, grow your business, and serve your clients best. That's at Global X ETFs. Gentlemen, thank you so much for doing that. And I'm really excited to tell you as well about the next webinar that we have coming up here at DAC FP. We have, let me bring this up here. We have a new webinar coming up that is asking the fundamental question, does tech still belong in client portfolios? We've seen the incredible rout of tech over the past year. Meta down 95%. By the way, your clients have lost more money in Meta stock than they have in Bitcoin. So that's going to be November 15th at 2 p.m. Eastern time. So I encourage you to register for that event featuring Ryan McCormick of Invesco. And then to learn even more about this and make sure you are conversational with your clients, we encourage you to enroll in our certificate in blockchain and digital assets. There's a price increase coming. The price is jumping to $879 at the first of the year, but you can enroll right now for just $649. So I encourage you to enroll. You can take your time completing the course, but by enrolling now, you secure the low price. This course is an online self-study program with a world-class faculty, 13 CE credits. First half of the course, all about the tech. Second half of the course, all about your practice management, the investment thesis and opportunities, how you build a portfolio, regulation, taxation, compliance. Most importantly, how to communicate with your clients and prospective clients about this. I encourage you to go to DAC FP and enroll in the course. And if you haven't yet read it, my new book, The Truth About Crypto, has now won an award. It's a finalist by the Society of Business Journalists as one of the best books of the year. So I encourage you to pick up my new national bestseller and award-winning book, The Truth About Crypto. A lot of advisors are buying it in bulk to give to their clients. If you would like to do that, contact us, because we can get you the copies in bulk at a severe discount to the retail price. I'm Rick Edelman. Thanks so much for joining me on the program today. Stay tuned for more from DAC FP as we continue to help you with your financial education in the field of blockchain and digital assets. Have a great day.